Hey everyone, welcome back to Corporate Decoder. Today we're diving into Northpointe Bankshares' latest annual report. And let me tell you, it's got more twists than a mortgage application during a rate hike. We'll uncover if this mortgage-focused bank is building a financial fortress or just rearranging deck chairs on the Titanic. First, the headline, Northpointe had a pretty good year. Net income almost doubled compared to last year, which sounds amazing. The big question is, how did they pull that off in a tough mortgage market? This report tells us about the year that just finished December 31, 2024. They're comparing it to the one before, looking for the story within. Before we dive into the numbers, let's get the official stuff out of the way. This is their annual report, also known as a 10K, filed with the Securities and Exchange Commission, or SEC. It's basically a deep dive into the company's performance and what they see coming. Northpointe Bankshares is located in Grand Rapids, Michigan. So they're a bank holding company, which means they own and control other banks. In this case, the star of the show is Northpointe Bank. They're also pulling in information from their proxy statement, which is what shareholders get before the annual meeting. We'll focus on this later if anything interesting comes up there. Now, before we get too excited, let's remember the fine print. Like every financial report, this one's packed with warnings about the future. These are things that could go wrong, and they want to make sure investors know about them. They talk about everything from the economy to interest rates to government regulations, basically anything that could make their business harder. Northpointe faces intense competition, but they say they're trying to be special by offering great service and quick decisions. A lot of banking is about relationships. They have that covered. It's important to point out this is their first year as a public company. Northpointe's business is broken into two main areas: the mortgage purchase program and retail banking. The mortgage purchase program is where they give independent mortgage companies the funds to operate, while retail banking handles regular customers. It sounds like a good way to have some backup. If one gets slow, the other could pick up the slack. Residential lending is the regular mortgages you expect. They offer the normal types of home loans and also what they call all-in-one loans. These loans combine a home equity line of credit with a checking account. Digital deposit banking is how they get people to deposit money. This is how they get their funding so they can make more loans. A large chunk of their deposits are brokered deposits. Finally, there's loan servicing, where they manage loans for other companies. They focus on specialized loans but outsource other simpler work. Banks are heavily regulated, and Northpointe is no exception. They're watched over by the Federal Reserve, the FDIC, and state agencies. As a bank holding company, they can't just go into any business they want. Their activities have to be related to banking. The government is very strict about this. The report also mentions capital requirements such as maintaining certain minimums and buffers above minimum. To pay dividends and keep growing, they need to be hitting these. There's a good summary of all the different capital ratio that they need to keep above a certain level. For example, to be well capitalized, the bank must keep a leverage ratio above 5%. If they don't meet these requirements, regulators can step in and things can get ugly. Since Northpointe is a holding company, they need the actual bank to make money so they can pay dividends to shareholders. There are state and federal rules about how much the bank can pay out. Just because there is money doesn't mean they can move it around freely. Regular checkups by regulators are a constant in the banking world. It's important that Northpointe keeps up with regulators or they could be in for it. There is the TILA and RESPR laws and all the consumer protection rules that the new bureau brought with it. Homeowner association liens are very interesting, as they could potentially take priority over mortgages. It's important to understand how HOA super liens could take priority. This is a risk. And plus, they are worried about cybersecurity, fraud, and the usual tech headaches. Let's get to the meat of the report, the numbers. Mortgage purchase program accounted for over 23% of the bank's revenues. This is where they give mortgage bankers funding. All their clients are mortgage originators, which is also where Northpointe makes their money, so it's all very connected. There is the risk of not being able to manage our credit risk well, and the reserve might not be enough for the loan portfolio. This is one of the biggest challenges all banks face. They need to invest and try to keep up with technology advances. There is always a risk of any claims or legal actions, which could be a big cost and a headache. Cybersecurity is also a very real fear that costs time and money. There is the risk from regulatory changes that might impact their growth. The FDIC could increase the costs for the bank for insurance. The bank might not be able to pay dividends, limiting their liquidity. The company started trading in February 2025 on the New York Stock Exchange under the ticker NPB. It's a new stock, so there will be growing pains. Now for the big one, management's discussion and analysis. This is the company explaining the numbers in their own words. The mortgage purchase program accounted for over 23% of total revenues for the year. If the program business goes down, it's bad for the whole company. They exceeded all the capital levels required by regulators. It's always good to have those levels up in case things get tough. All right, now for the official financials. Effective January 1, 2023, they have to use this new credit loss accounting standard. CECL, it depends a lot on guesswork and economic forecasts, which of course can be wrong. The allowance for credit losses is important. It's management's estimate of the loans people won't pay back. The allowance for credit losses was a tiny 0.25% of total loans at the end of the year. That's super low, but they say it's because most of their loans are super safe and they use strong processes. It will be important to see how the trend goes with their new numbers. They service and subservice loans too, which includes dealing with payments, taxes, and insurance. All the mortgage loans originated by the bank are subject to the know before you owe rule. This could have effects on how you collect the debt in general, so the lawyers are important here. The banking regulators come up with guidelines regarding cybersecurity. These could increase the time and effort that is needed to invest in new technologies. The cash and equivalents at the end of the year increased up about $25 million. The board of directors is made up of business leaders who have lots of experience in different industries. Northpointe is still an emerging growth company, which means they don't have to follow all the rules that bigger companies do. For example, they don't have to have their internal controls audited as closely. It's good for them, but it means investors don't get as much information. The people in charge, called beneficial owners, also own quite a bit of stock. That's good because it means they have skin in the game. The downside is they still have a lot of influence on votes at the company. Their accounting firm, RSM, charges them fees for the audit. The report doesn't mention disagreements with the accounting firms. Management says their internal controls are effective, but with one small flaw, the way they were classifying revenue from mortgage servicing. They fixed it, so it's hopefully not a problem going forward. Nothing preventing inspections at the moment. There was nothing to report on foreign jurisdiction inspections, but I did note they do have some foreign entities. Overall, it was a pretty good financial year for them, and there were some big bumps in bonuses. A large portion of their assets involves subjective judgment on their fair value measurement. This area can be very volatile. Their regulatory capital was above what is required, so all good there. The company might have to restate previous reports or file documents late because they still are working towards fixing their internal control issues. This will cause them to lose investor confidence. And that concludes the report. Let's have an analysis and overall impression. Overall, Northpointe bank shares seems to be in a decent position strategically. The shift towards higher margin loans appears to be paying off, and managing to reduce expenses while doing that is key to long-term success. If interest rates don't rise too much and they can keep their costs down, they could see the stock price grow. However, it will be important to keep an eye on non-performing loans. If that number starts to creep up, it could be a sign of trouble. The low allowance for credit losses is something to watch. If their super safe loan strategy doesn't work out, they could take a hit. Their relationship with those big institutional investors, their interests might not always align with those of smaller shareholders. In conclusion, I like Northpointe's focus, but I'd be cautious until they have a longer track record as a public company, especially with having long-term cost increases. And that's it for this deep dive. What do you guys think? Let me know in the comments, and please like and subscribe.